The 2025 AI Capital Truth. This is not the end of a bubble, it has a structural reset preface. Cutting through the fog of price, a lot of people are panicking about AI stocks right now. They think prices have climbed too high, too fast. They stare at the red and green flickers of stock tickers, fixate on historically elevated P/E ratios, and find themselves rattled by violent short-term swings. Every pullback makes them doubt their judgment. Every rally leaves them kicking themselves for not acting sooner. This emotional whipsaw is, at its core, a failure of mental framework. These investors are applying the logic of grocery shopping: buy when it's cheap, avoid when it's expensive, to what is actually a foundational restructuring of human productivity. Here is what I want you to understand. The deep logic of capital markets has never been about the current price. It has always been about the direction of capital flow. When a disruptive technology transitions from the laboratory phase into the infrastructure build-out phase, capital enters a multi-year deployment cycle that dwarfs any short-term price movement. The internet was called overvalued in 1999. Electrification was dismissed as a speculative bubble in 1910. But those who understood the structural shift and held their conviction captured the defining returns of the following decade. AI today sits in the deep water of exactly that kind of cycle. And deep water is precisely where most people lose their nerve, and where patient capital wins. Part 1. Price thinking versus structural thinking. Most retail investors operate on what I call price thinking. If it's gone up, it feels expensive. If it's fallen, it feels cheap. This instinct is not irrational. It works perfectly well at the supermarket. But transplanted into capital markets, it becomes one of the most reliably dangerous cognitive traps in existence. The large pools of capital that actually move markets operate on an entirely different framework: structural thinking. They are not asking, is this cheap or expensive? They are asking a different set of questions altogether. Is this industry in a capital expenditure expansion cycle? Is the underlying demand structural or cyclical? Where does this technology sit on the adoption curve? The core of structural thinking is understanding where money is flowing and why. When Microsoft announces $80 billion in AI infrastructure investment over 3 years, when Google, Amazon, and Meta all raise their capital expenditure guidance in the same earnings season, these are not impulsive decisions made by executives chasing a trend. They are multi-billion-dollar bets made by people with access to more data than any retail investor will ever see on what the competitive landscape looks like in 2030 and beyond. They are voting with real cash on the future. As long as the orders from the hyperscalers keep growing, as long as the compute gap keeps widening, the day-to-day valuation debate is nothing more than surface noise on a very deep ocean. Every panic-driven sell-off, viewed through the lens of structural thinking, looks less like a warning sign and more like an opportunity extended to those with the patience to take it. Want to know where the big money in AI is really going? It's not just about the obvious stuff. The best way to understand AI investment is to think of it like ripples in a lake. You drop a stone, and the energy moves out in 3 clear rings. First, there's the core compute ring. This is the one everyone talks about: GPS. When giants like Microsoft, Google, and Meta pour billions into AI, the first stop for that cash is NVIDIA. Their H100, H200, and new Blackwell chips are the heart of the machine. This ring is super visible, which means prices swing wildly. It's easy to get caught up in the hype and buy high if you are not careful. The second ring is the supply chain. The money doesn't stop at the chip. To make those GPS, you need a whole ecosystem. Think TSMC for manufacturing, SK Hynix and Samsung for specialized high-bandwidth memory, and advanced packaging technologies that are the biggest bottleneck right now. This is a deep, complex chain where every single link is crucial. A shortage anywhere drives prices up for everyone. Smart money moved into these less-known players long before they hit the headlines, finding great value without all the speculative noise. Now for the third and most important ring for the future: energy and infrastructure. This is the real final frontier. AI data centers are incredibly power-hungry. One large center can use more electricity than a medium-sized city. As we build hundreds of these all at once, the strain on our power grids is becoming immense. Capital is now starting to shift from chips to electricity generation, grid upgrades, natural gas, and even nuclear power. Microsoft is buying nuclear energy. And Google is investing in small modular reactors. This isn't a side story, it's the main event. The race for AI dominance won't be won by the smartest algorithm, but by who can secure massive, reliable power. Energy is the ultimate resource. And whoever controls it will control the future of AI. Thanks for watching. If you want to stay ahead of the curve on tech trends like this, make sure to subscribe for more insights. Part 3. Where exactly are we in the cycle? Knowing where you stand in a cycle is the prerequisite for making sound decisions. Let me map out the 3 phases of this AI supercycle clearly. Phase 1 to 3. The arms race. The defining word is hoarding. Checked, arrived, and detonated. An existential crisis across the technology industry. Every major player rushed to stockpile GPS, terrified of falling behind. Nvidia's order backlog stretched to months. Black market premiums were staggering. This was the period of maximum speculative excitement and the peak moment of profitability for core hardware suppliers. Many retail investors who chased the hype at the top of this phase experienced the pain of the 2024 correction firsthand. Phase 2 to 5, inference scaling and capital confirmation. Where we are now, the defining word is deployment. AI is moving from concept to reality, embedding itself into enterprise software, consumer applications, and industrial processes. Inference demand, the ongoing recurring need for compute to run AI models in production, is becoming normalized and commercially validated. Hyperscalers are shifting from frenzied stockpiling toward disciplined, large-scale operational deployment. This phase is characterized by a fascinating tension, surface-level skepticism coexisting with accelerating underlying build-out. Markets debate ROI, commentators declare the bubble is bursting, and yet the cranes keep going up over data center construction sites, the CapEx guidance keeps climbing, and the enterprise adoption numbers keep improving quarter after quarter. This tension is not a sign of a top, it is the signature of a mid-cycle. Real tops do not arrive in an atmosphere of debate and doubt, they arrive when the consensus is universal. When everyone has already bought in, when the last skeptic has capitulated. We are nowhere near that point. Phase 3 2026 to 2028, full economy penetration. The defining word is automation. AI becomes ambient infrastructure, as invisible and indispensable as electricity or the internet. In this phase, the greatest beneficiaries will not be the chipmakers but the industries that have successfully converted AI capability into tangible productivity gains, energy and utilities, having quietly underpinned the entire AI edifice, will emerge as the defining capital story of the decade's second half. Part 4. The 3 red lines that actually signal a top. Too many investors waste energy trying to predict the top through stock price patterns. Price is a result, not a signal. What you should be tracking instead are the underlying industrial indicators. There are exactly 3 red lines that would genuinely indicate it is time to reduce exposure. Red line 1. A meaningful, sustained decline in CapEx. The hyperscalers stop buying shovels. This is the most direct and reliable signal available. When Microsoft, Google, Amazon, and Meta begin guiding down on AI infrastructure spending in their quarterly earnings calls, not just a one-quarter blip, but a sustained directional shift, it means the people with the best view of actual demand have fundamentally changed their assessment of the future. As of today, the aggregate AI capex from these 4 companies continues to rise each quarter. There is no top signal here. Red line 2. Large-scale order cancellations. Demand is proven false. If AI cannot generate genuine commercial returns, enterprise customers will begin canceling subscriptions, scaling back deployments, and ultimately pulling back hardware orders. This would trigger a classic semiconductor down cycle, the domino effect that devastated memory chip makers in 2022. At present, cloud providers' AI-related revenues continue to grow at high double-digit rates. Enterprise adoption curves are still ascending, and there are no systemic signs of demand cancellation. Red line 3. Supply chain inventory buildup. Chips are piling up unsold. This is the most classic indicator of a semiconductor cycle peak. The 2022 to 2023 consumer chip collapse was driven by exactly this dynamic. Pandemic era overordering created massive inventory overhangs that took nearly 2 years to clear. Today, AI chip supply remains tight, Delivery lead times have shortened somewhat from their peak but remain elevated, and there is no evidence of systematic inventory accumulation. None of these three conditions have materialized in any systematic way. The volatility we are experiencing today is better explained by profit-taking rotations, macroeconomic uncertainty-driven risk management by institutional investors, and normal mid-cycle sentiment oscillations, not by any fundamental deterioration in the underlying industrial story. Understanding this distinction is what separates signal from noise, and separating signal from noise is what separates good investment outcomes from bad ones. Part 5. The cognitive traps facing individual investors, and how to escape them. Understanding the macro structure is necessary but not sufficient. The practical question for any individual investor is, how do you actually position yourself to benefit from a structural shift of this magnitude without getting destroyed by the inevitable volatility along the way? The most common trap is applying tactical level thinking to a strategic level opportunity, trying to perfectly time every NVIDIA pullback. Chasing each new AI concept stock as it catches fire, this is taking a structural phenomenon and reducing it to a speculation game. The result is predictable. Every swing produces anxiety. Every decision produces regret. And the actual long-term return ends up being far below what a simpler, more patient approach would have delivered. The path out of this trap is converting cognitive advantage into time advantage. If you genuinely believe, based on the structural evidence laid out here, that AI infrastructure build-out is the defining industrial theme of the next 5 years, then your job is not to predict next quarter's stock price. Your job is to build a position structure you can actually hold for 3 to 5 years, diversified enough to survive individual stock dizzes, concentrated enough to meaningfully participate in the secular upside, and sized appropriately so that a 40% drawdown doesn't force you to make emotional decisions. Time is the most powerful advantage available to the individual investor. Patience is the only way to deploy it. Conclusion: be a hunter of time, not a prey of price. AI is not a one-year speculative episode that ends with a crash and a lesson learned. It is a sweeping, multi-decade reallocation of global capital, one that, in terms of scale, duration, and breadth of impact, may only be comparable to the Industrial Revolution and the commercialization of the Internet. Capital is moving, deliberately, systematically, and at enormous scale, away from the low-productivity industries of the 20th century and toward the compute infrastructure that will define the 21st. This process is nowhere near complete. What we can see today is only the first chapter of a much longer story: the mass market proliferation of inference chips, the commercial explosion of AI agents, the historic reconstruction of global energy infrastructure, and developments we cannot yet imagine. All of this lies ahead. Real investing is not about chasing whatever is catching wind today. It is about understanding the structural forces that create the wind in the first place. It is not about crowding into the most popular position. It is about understanding where the crowd is going before they get there, and being patient enough to wait for them at the destination. Be a hunter of time, not a prey of price. That is the only capital survival strategy that truly matters in the age of AI.